Hello, I'm Chris Pedersen, and this is Stock Watch for Wednesday, the 13th of March, 2024. All information is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. A few market observations. First, the U.S. economy is doing very well. Employment is strong, inflation is under control, and the stock market is making new highs. This gives our market confidence to be invested also. Our inflation will take longer, though, than the United States to decline, and that's because we have market dominance by fewer companies in more sectors. That's simply a factor of excellent, well-run managed companies and a smaller market. This is an amazing chart that I wanted to share with you. It's about Australian banks and their PE ratios. Take a look at the right side. That's like the last 6 months. What you see is the PE ratios are rising to levels never seen before. It is extraordinary how overvalued Aussie banks are. Now, when interest rates decline, maybe the stocks will grow into current prices, but right now they're overvalued. Requests for Stock Watch. Well, over the reporting season, I got quite a few requests. Today I'm going to cover 3 companies. Next week I'll cover some more. The first one is Woodside Energy, WDS, and it's trading right now around $28.96. This is a company that I like a lot and I follow closely. However, the price of oil has been dropping, price of natural gas isn't all that great because of a lot of supply on the market. You see it in the price. Woodside has been going south. Looking at the fundamentals, these estimates, by the way, are from Macquarie Bank. This company has a market cap of $58 billion. This is a big company. Price target, UBS has $31, Macquarie has $32. However, brokers are all over the place. Revenue growth from 2023 to 2026 averages around negative 11% per annum. UBS is better than Macquarie in terms of these estimates. Earnings growth is estimated negative 30%. Dividend growth, negative 30%. This is because the price of these materials, oil and gas, are estimated to be declining. My view on Woodside, I'm not going to go into PE ratios or anything like that. I'm just going to tell you my view. 1, it's very well managed. 2, it's got excellent reserves and production. None of this matters, though, if the price of oil and gas declines. As a consequence, it is cyclical and speculative. We cannot predict supply from OPEC. Geopolitical issues always enter into the equation. How much oil will the United States pump? Will Russia continue to be able to pump oil into the global markets? Right now, it's curtailed a little bit. What about Iran? Saudi Arabia has cut back production some, but they can't cut back too much because they're running at a deficit and they need the profits. So there's so many factors that enter into things that impact Woodside's price outside of management being very good at what they do. Ticker data. Code on this company is DDR. It's currently trading at $10.89. This is a 5-year chart and it really shows that it's meandering. It dropped COVID, it's rallied some, it's stagnating now. Let's look at the numbers though, and what does this company actually do? 1, it has a market cap of a little more than $2 billion. I have a 12-month price target of $12.40. Revenue growth for each of the next 3 years is around 3% per annum. So this is not outstanding for a technology company. Earnings per share growth, 8% per annum, and a dividend growth 9% per annum. So this is nothing like Facebook or Nvidia or something that have growth rates that are extraordinarily huge, but then they also have price multiples that are equally high. Looking at PE ratio, at 2025 earnings per share estimate of 57 cents, this company is only trading at 19 times. But bear in mind, it's growing, but not massively growing. The yield on the 2025 dividend of 54 cents is 5%. For a technology company, this is a high yield. Free cash flow is only around 3%. Now this is something that really strikes me as interesting. It has a payout ratio of around 95%. Dicker Data is a hardware and software provider. They distribute Toshiba and compact laptops. They've made acquisitions over the years. They do not excite me. I rate it neutral. It's growing, but not massively growing. It's fairly priced. Yes, it's going to go up. Will it outperform the market? Probably not. AGL Energy, code AGL. Price is currently $8.64. Well, look at where it was 5 years ago. Look where it has gone, and now it's rallied. But you notice past 6 months or so, it's been declining again. So what's going on with this company? They reported like the 27th of February, and the brokers are estimating a price target of $10.45. Some brokers are naturally a lot higher and some are a lot lower. This is like an average price target. This company, by the way, AGL, it's only $6 billion of market cap. Revenue growth rate for 2023 to 2026 is around -1% per annum. So that's not that good. Earnings per share growth in that period is 20% per annum. That's excellent. And the dividend growth is around 13% per annum. To me, I like the dividend growth because you have to actually have earnings to pay out dividends. But this is a utility company. They have a lot of depreciation. It's not that simple for AGL in terms of what are their forward estimates. Now looking at PE ratios, the 2025 earnings estimate of 85 cents is only 10 times earnings. So that's cheap. The yield on the 2025 dividend estimate of 47.5 cents is 5.5%. That's good. Utility companies, energy companies should have a high yield. Free cash flow is around 5% payout ratio. Well, I have 55%. The reality is right now it's around 50%, and come 2026, it's going to go up to around 60 or 62%. So the 55% is like an average over the next few years. This is an energy provider. As I mentioned before, brokers are all over the place with their forward estimates. I view it as high risk due to how energy supply will be sourced in the future. We don't know how it will develop. Will it truly be electricity-based? Could it be hydrogen-based? We don't know for sure. As a consequence, I rate it neutral. Also, looking at the chart from a timing perspective, this stock is trending downwards in a bull market. That is not a very good sign. I wait for it to bottom and then maybe start to rally before I would consider buying it. At that time, I'll re-look at the fundamentals and determine. Right now, I just rate it as neutral. As always, if you want to learn more about anything I covered, send an email request to stockwatch@fnn.com.au and direct it to me, Chris Pedersen. I hope you have an excellent and profitable week. Thank you for your time.